Hi, I'm Mark Anderson, a loan officer with Cornerstone Mortgage. What I wanted to do today was to talk about how to, when you're getting various mortgage quotes, is how to compare apples to apples. I think it's kind of an overused metaphor in the business. Any lender that is doing a good job will probably spend some time discussing with you how to compare the numbers that they've provided you with the competition. The problem that I've got is simply telling someone to compare apples to apples. It honestly just isn't good enough. You need a little bit more information to make sure that what they're telling you to do is something that you actually have the information to make that accurate comparison. So the first thing that I'll say in comparing apples to apples is it's actually really important to understand the structure of a mortgage quote and how it relates to the good faith estimate. Okay? I've got a Terrible Advice Tuesdays blog post about how you can't rely on the good faith estimate to shop for your loan. And I certainly welcome you to read that article for a little bit more information there. Essentially, the problem with the good faith estimate is it's not provided until after you apply for the loan. So you put all of your personal information together, submit it to a lender, and only then can they provide you a good faith estimate. In my opinion, that's not good enough. You should be able to shop for a loan without having to go through that process. So I'm going to take this week's video to explain very, very clearly how to make sure you're comparing apples to apples and not apples to bananas. So in understanding the structure of the good faith estimate and how it actually relates to doing this, what you need to know up front is that there are two sets of fees on the good faith estimate. There's box A and box B. The fees that we're concerned about are the fees under the section A, box A. Box B includes all of the fees that the lender really doesn't have anything to do with. So when you're asking the lender to put your quote together, you need them to tell you the fees that are going to be in box A. And I've actually got a trick here that will help make your comparisons easier. Okay. That's how the good faith estimate is related to this. Now we need to talk a little bit about interest rates and how they work. One of the most common questions that I get from new clients, whether they're referred by a real estate agent that I work with or whether they found me on my website, is, and it's unfortunately the wrong question to ask. It is, Mark, what is your interest rate today? The problem with this question is it betrays the fact that the person asking doesn't truly understand how interest rates work. And they don't understand the fundamental principle that the interest rate that's on offer is influenced directly by the amount of fees that the lender is charging. And this brings us back to that box A of the good faith estimate. Long story short, the interest rate that I offer you on a given day comes with some amount of fees attached to it. Now, the rate any given day might be what that lender considers to be the rate with their standard level of fee. Now the problem with that is that when you're comparing apples to apples, you need both of those variables in sync. What I recommend doing is this. Because we know that the fees impact the interest rate and vice versa, why don't we remove one of the factors from consideration right off the bat? It'll make it much simpler. What we can do is ask any lender that we talk to simply provide us the interest rate for zero in fees. So the number that would show up in box A of the good faith estimate is $0. At this point, you get the rate with that lender for that day for zero in lender origination. All of a sudden, this will make your comparisons much, much easier. You're literally comparing the rates against each other with the fees off the table. Now, if at the end of the day, you want to pay something in fees to obtain a lower interest rate, sometimes that's called buying points, you can do that. But at the stage of comparing to see which lender has the best deal, it's going to be most beneficial for you to simply isolate that variable and move on with that lender. $0 in origination one day might get you 4.25% on a 30-year fixed. Maybe with $750 or $1,000, maybe you can get that rate down to 4.125 or 4%. Make those kinds of decisions as far as how you want to customize that loan. Make those kinds of decisions down the road once you've determined what lender is offering the best overall deal. Now, the only other consideration that you need to make is it's unfortunately not just as simple as the interest rate and the closing costs. You've also got one other really critical factor to consider. You have to make sure that the product that you're comparing between lenders is the same product. Now, saying that you're comparing 30-year fixed mortgage quotes sounds easy enough. But when you're putting less than 20% down, you've got to handle private mortgage insurance, or PMI for short. There are various ways to handle PMI, and I'm going to cover that in another video. At the end of the day, make sure that it's a 30-year fix versus a 30-year fix, if that's the program that you're looking at. Make sure they're handling the private mortgage insurance in the same exact way. And of course, make sure there's no prepayment penalty, balloon payment, all that good stuff. But just make sure that the product that you're comparing is accurate as well. Go zero fees in the lender origination. What's that rate? Much easier to make the comparison that way. If you have any questions, feel free to contact me anytime. Of course, you can find me on my website, markandersonmortgage.com. You can call or text my direct number, which is 314-599-0511. Thank you.